when the overall markets start anticipating or starting to display indecisive trading, as you can see, the Dow had a good consistent trend. One relevant factor was that it could never trade or close below the T line. But over the last few weeks, you can see that even though it was still in an uptrend supporting on the T line, there was lots of indecisive trading days, doji type days. This made the uptrend a little bit skeptical, and a reversal was not implied until this very strong signal, a doji followed by a bearish engulfing signal. That is one of the top-ranked candlestick reversal signals in the candlestick universe. This told you that this was definitely a strong selling occurring. As we can see in the NASDAQ, it also was in a steady uptrend, staying above the T line. So today's trading took it down, but brought it back up above the T line. However, it still formed a bearish left-right combo. This may indicate that it might be a pullback, but not nearly as strong as what might be seen in the Dow. This also allows the candlestick investor to be prepared for knowing how the market should open after a reversal signal. So if we wake up tomorrow and the pre-market futures are very bearish, we know it's confirming the sell signal, and it's time to be coming out of your more of your long positions and adding more short positions to the portfolio. A reversal in the market does not necessarily mean every strong bullish position is ready to roll over. As we can see in our recommendation on PDD over the past few weeks, it's still trading up above the T line, and today it did a bullish doji sandwich, telling us there's still probably more upside, which means it could break out through this level, heading up into this trajectory. This still implies there's strength, even though the market was weak today, in a strong candlestick bullish signal. Delphi, DLPH, also is illustrating a J-hook pattern, implying there should be more upside, the same magnitude as this move right here, with the evidence that this hammer doji bounced right off the T-line and started back up again. So there's still good long positions availing themselves in this market. But as the market was up in the overbought condition, there are individual positions, such as Tesla. Notice how Tesla did a hanging man, followed by a gap down that brought you not only back below the 50, the 200, the 34, and the T line, but it closed well below that level by gapping down through those levels, implying that this downtrending channel is probably still heading down here to the lower range. Knowing this, and knowing that the market is getting a little bit toppy, would have had the candlestick investor adding short positions to the portfolio while closing out long positions that were running out of steam and taking profits in those positions. There is a very simple rule in candlestick analysis. You can stay long until you see a sell signal and a close below the T line. Just that factor alone allows a candlestick investor to have a much higher probability of looking for short positions in these type of situations, and pretty well estimating where the target would be to the downside. In this case, there's a gap to be filled right here, which would also correlate with the 50-day moving average. We know what type of signal this sets up. This little bearish engulfing after a hanging man signal and a close below the T line, a doji day. If it opens lower tomorrow, a bearish doji sandwich would imply more downside. Knowing the little secrets, not secrets, but the results of candlestick signals and trends allows a candlestick investor to be appropriately positioned when a market reversal is about ready to occur. That'll be it. We'll see you in the chat rooms.